ladies and gentlemen and work experience students, let's do our third video, types of companies. All right, let's say do like a little revamp here. What is a stock? It's when you buy a small piece of a company. What does it mean when someone says that the stock market is up? It means they probably looked at an index. It's like the Dow Jones, the S&P 500, the NASDAQ, and by looking at a few companies, they can kind of interpolate how the whole country is doing. What is a stock index? The three major ones are the S&P 500, the NASDAQ, and I can't remember the other one. Oh yeah, and then there's the Dow Jones. Okay, so what are the two main ways to make money in the stock market? Buy low, sell high. And then the other way is to get dividends. So you get a little piece of the profit. What is the easy, foolproof way to become a millionaire by age 65? You start early, invest regularly, and invest in companies that make a 12% return on your investment. What is a brokerage account? It's who you buy and sell stocks through. A lot of them now are online. What is a custodial account? It's a brokerage account that you can use as a minor because you go in on it with one of your parents or guardians. What's a mutual fund? That's when a bunch of people give money to one company and they spread it around to a bunch of different stocks, bonds, and other securities. What is an ETF? It's an electronically traded fund. It's basically like a mutual fund, but it's done online. What is an index fund? It's a mutual fund or ETF fund that invests in one of the indexes, such as the NASDAQ, the S&P 500, or the Dow Jones. What is a ticker? It's the symbol for that company. Every company that's traded on the stock exchange has a ticker, and so it's their symbol. Okay, now here were the simple strategies I went over for you to invest. So buy a company that you know about, like you know about their products or services. Do some research first, though. Follow advice. Just go on to the internet, follow some advice, ask somebody you know, and just try. It may not be the best way to go, but just getting started in the stock market is a great idea. Choose a blue chip stock after some research. A blue chip stock is a large cap or a really big company that's typically well known, and they typically do well year after year when the economy is good or bad. You could choose an index fund that follows the Dow or the S&P 500 or the NASDAQ, or you can choose an ETF fund. Now, there's a bazillion ETF funds, and so you'd have to do a little research and find one that you like. Okay, here's some principles we learned. The earlier you get into the stock market, the better. Let the compounding interest work for you. Principle 2, it's all about performance, perception, and environment. So the prices of stocks are based on the performance of the company. How good of a company is it? Some of it's not even how good they are. It's just how people see the company, good or bad, right or wrong. And then some of it's the environment. So for example, right when I made this video, all the stocks were down because of inflation, and the inflation was definitely not those companies' fault. So things outside the company's control can control the price. Principle 3, buy low, sell high. Stock market's down, buy. Principle 4, spread your risk around or diversify. So put your money into a lot of different companies, a lot of different types of companies, real estate, all kinds of different things. All right, so we learned about a mutual fund where lots of people, lots of investors give an investment firm a bunch of money, and then they take that bunch of money and they buy stocks and bonds and other securities. So it's automatically diversified because it's spread out to a bunch of different things. Okay, so now we're going to learn new stuff. Okay, so a company has a capitalization, which is the market value of its outstanding shares. So let's say there's a company, well, I'm going to make the number simple. Let's say that a company had 100 shares, and each share was worth $2. Okay, well, then the company would be worth $200. Okay, the numbers are a lot bigger than that. Okay, but anyway, you can figure out like exactly how much a company is worth. You look at the number of shares, how much each share costs. That's how much the company is worth. All right, so there's 4 types of stocks or mutual funds. By the way, anytime you see stuff in red, write that down in your notes. There are 4 types of stocks or mutual funds: aggressive growth, which is also known as small cap. So small cap means it has a small capitalization, which means it's a smaller company, which means it has room to grow. So the idea is you invest in that company and it grows. Growth or mid cap, which means it's a medium-sized company. It's still going to grow. Then you have growth and income, which is a large cap. It means it's really big. It's not, the company's not going to grow that much, but it is going to make profit, and you're going to get some income. So a large cap is also known as a blue chip. And then the fourth area you can invest is international. And so those are just any company that's not American companies, but in within those you can have international aggressive growth, and growth in income. So let's talk a little bit more in detail about each of these. So aggressive growth or small cap. So this seems big, but this is small for the stock exchange. So the company is valued at 300 million to about 2 billion. And so these companies are newer, and they still have a lot of market that they can gain, they can grow. So the idea is that you buy low and they're going to grow fast in value, and you can sell high. So a little bit more risky. So you want this stock price to grow. So you don't really necessarily want dividends from this company. What you want them to do is take their profits and reinvest it in the company so that they can grow faster, right? So small cap, you want to make your money by buying low, selling high. All right, growth, mid cap. So these companies are worth from 2 billion to about 10 billion. So these are companies that are well established, but they're still able to grow. The risk is less, so it's a medium risk. You definitely want the stock price to grow up, and then dividends would probably be a good thing from this company. So you want them to make a profit and give you a piece of it. And then there's the large cap. It's the least risky. Probably the value is not going to go up as fast as others, but it should go up slow and steady in good times and bad. On a company like this, you're going to want dividends for sure. So they're well established. They should be making a good profit. You want a piece of that profit. So a blue chip stock is another name for a large cap company. It's a well-established, financially sound company that has operated for many years. You probably know the name. Okay, international companies are international, and there's the three types. All right, so a recap of my investment strategy: start early, invest regularly, buy and hold on to a stock for 5 years. So like it may go up and down, but hang on to it as long as the company's solid, as long as they're making good products and services and have good management. Diversify over time. So as a young person, you don't have to diversify right now, because if you lose everything, it doesn't matter. You have plenty of time. But over time, you want to diversify and get a bunch of different kind of companies. Spread your money all around. So invest in things you understand after some research. Take advantage of changes. For example, like I said earlier, when I'm making this video, inflation had killed the economy. Stock prices were low. It's a great time to take advantage, put as much money in the stock market as you can. And then get a teacher or an advisor that has the heart of a teacher. So you wanted a financial advisor that'll teach you stuff. So this is what I would have you guys to do as you're investing. Let's talk about real estate. Real estate is definitely part of your key to becoming wealthy. Being able to give generously and retiring with dignity. So the idea with real estate is buy a house, a duplex, an apartment. You can buy commercial property. So like a Walmart building is a commercial property. The Lowe's is a commercial property. All the buildings downtown are mixed because they're commercial and they have some apartments above. But that's what commercial property is. The idea is you get rent and it increases value over time. So when you sell it after 10 or 20 years, you make a lot of money, especially in California. Real estate seems to always go up in California. The risk is relatively low. The return is medium. The liquidity is very bad. It takes a long time to sell a house or a building. So here's some good things about real estate and bad things. I mix these all up. So it takes more time, right? So you have to spend time repairing things. You have to spend time managing the renters. And it's hands-on. You are liable and can be sued. So like if you buy a stock in Apple Computer and Apple does something bad, you as a stockholder can't be sued. But if you have a house and you don't maintain it and somebody gets injured, you can be sued. It's one of the few investments that you can borrow money on. So borrowing money is not great. You don't want to be in debt. But on the other hand, I've done an investment where I got a loan, bought a house, remodeled it, flipped it, made a bunch of money. And I didn't have to use any of my own. At that time I had no money, so I didn't have any money to invest. So I used the bank's money. So that can be good. Definitely adds to the risk. So not really a proponent of that. Okay, here's more things about real estate. You have a lot of money in one place, so it makes it difficult to be diversified because it's worth a lot of money. They're expensive to buy, expensive to maintain, very hands-on if you're not into that. You have to deal with people. Renters can be awful. Get a property manager, and that helps with that. You need a lot of cash up front. You got to save cash to fix it. So like I had a renter move out and cost me $16,000 to repair one mobile home, and that was just minor repairs, just carpet and things like that. So you make some good money, but you got to definitely stash that away. Okay, all right. So let's go with bonds and other securities. So bonds are not really your key to becoming wealthy. They're a part of your strategy, but they're not a way to become wealthy. Okay, so let's talk about just securities in general. So securities are bonds, stocks, and other documents sold by government and businesses to raise money. So bonds and stocks are all part of securities, right? But why? But why do people buy stocks and bonds? Because stocks are a little more risky, but the reward is higher, and you need that higher return on your investment to retire well. So that's why people do stocks and bonds. So people do bonds because they're safer, and it's something. So like as you get older and closer to retirement, you transfer your money to bonds because they're safer, right? Because like when you're your age, if like you lose, like everything goes way down, like who cares? You're like 30 years away from retirement, right? Or 40 years away from retirement. But when you get into your late 60s and you're thinking like, oh, I'm going to retire, it's like you can't. You need to start spending that money, right? And so if it takes a big dip, that's not going to work well. So you start moving it into bonds to keep it safe. So a municipal bond is when you get a bond from a city or a county. So you're buying a government bond. So a regular bond is you're loaning money to a company. A municipal bond is you're loaning money to a government. Okay, a bond is a debt instrument. Okay, so basically you're not buying into a company like with a stock. You're actually giving somebody a loan, right? So debt equals loan. So a municipal bond is you're loaning a city. A corporate bond is you're loaning to a company. Okay, so the rate is low, the risk is low and to medium. Liquidity is medium. You can sell it at a loss. If you sell it fast, you might have to sell it at a loss. So bonds are determined by buyers and sellers in the bond market. So just like stocks are in the stock market, it's usually based on the interest rate. So if you have a company you give a loan to a company, they're giving you a good rate of return, and then another company comes out and gives you an even better rate of return, well, then the price of your bond could go down. So you can buy and sell this loan, which is kind of funny. All right, so the idea with bonds are you want maybe a little bit of money in your bonds for safety, not much, and as you get older, you put more and more, and you transfer it to bonds for safety because they're guaranteed. So like if you give a loan to somebody, by law they have to pay you back. So unlike the stock market, if you buy a company, well, the company could go bankrupt and they don't, like, so you own the company. If they go bankrupt, you don't have anything. Okay, so there's this thing called a CD. A bank gives this. So like you give them money and they give you a determined interest rate. It's super safe, but you get very little money on it. So it's not worth it. So inflation is typically higher than what you're going to get on a CD. So you actually lose money by putting money into a CD. So don't do that. A commodity is when you buy gold, you can also buy like cattle futures. So it's like, oh, I'm going to buy all these cows and then sell them. So you don't actually take possession of the cows, but you can still buy. And same thing with pork bellies, that you're buying pigs, gold, platinum, silver. You can buy barrels of oil. It's a largely homogeneous product. So here's a question: what is the golden grain doing to increase your investment? And the answer is, it's not like growing grain. It's like grain that they've already harvested and they're storing. And the answer is nothing. So when you invest in a commodity, it's not like investing in a company where like, oh, we're going to take your money and we're going to do something with this business and we're going to grow it. It's like, no, you're just hoping that the gold prices go up for some reason or the grain prices go up for some reason. So it's kind of a gamble. So you're betting on the prices going up or down. So it's pretty risky. I don't recommend it. If you're totally into it, you can investigate it and figure out if it's something you really want to do. I don't like it. So to me, like I listen to the radio and they're constantly trying to get me to buy gold on the radio. It's like, okay, well that means there's somebody making a lot of money from me buying gold, and it's probably not me. Let's see. All right, so that was it. So there's um, I don't even know what all this is. So there's an assignment called, there's a quiz to take, and that's it. Yeah. Thanks, guys.